Good afternoon, everybody. Welcome to the ICMA Repo and Collateral Council's annual meeting. I first like to show you the results of the elections we had every year, as you know, to keep people's minds fresh and keep active. So we unfortunately lost two very good members in the past. That's Rich from Swiss Re and Jean-Michel Meyer from HSBC. And the two vacant places were taken by Thomas Hansen from Banco Santander and Ned Taylor from HSBC London. So that's the team that is responsible for your well-being.
So this is the longest survey. Well, it's the major survey in the European market. It's certainly the longest in any market, I think. Okay, so the headline number, 8.285 trillion. Just to remind you, this is the outstanding balance of positions. This is not a turnover number. It's a snapshot on the day of the survey. And the surveys are the second Wednesday of June and the second Wednesday of December. And the 40th survey was on the 9th of December. So that, in theory, is a rise of 5.1% since the June survey and a decrease of 0.3% since the December survey, so year on year. But of course, the composition of the survey changes, and we adjust for that by looking at changes for a constant sample. And in that case, the size of the 6-month increase falls to 1.8, and the year-on-year decrease increases to minus 3.6. In other words, much of the increase we see from June to December and is basically due to a change in the composition. So the survey is essentially flat. Now that's an interesting point because we of course had the dash for cash and frenetic trading in the first half of 2002. And essentially the effects of that have not persisted in the overall size of our sample. And to a large extent, that's to be expected because a lot of the trading was very short term. So it will have run off by the time of the December survey. And more generally, many of the changes that occurred as a result of the COVID pandemic, many of those have disappeared, but some are still working their way through the market, as we'll see. But looking at the big trend, we appear to be at the end of the third phase of the evolution of the market over 20 years. So coming perhaps to the end of the rise that we've seen since 2016. Of course, we can now compare our survey with the SFTR result public data. And if we look at the outstanding numbers published under SFTR, when we look at the very first, the June survey, we see that the survey and the SFTR numbers are almost the same. But when we look at the December survey, we see a big gap has opened up, and that's what we would have expected. Our sample of 60 banks really only covers part of the market, even though it has many of the largest banks in the European repo market. And in December, our survey covered about 58% of the SFT number. The opening up of that gap is probably more due to improvement in reporting performance than any underlying growth in repo. So we cover almost 60% of the European repo market according to SFTR, which means that our survey has a very good coverage. You can see, of course, the effects of Brexit or the end of the Brexit transition period there. There's a bit of a wobble in the UK data, but essentially you can see the two paths start to diverge. If we look at the average daily turnover published under SFTR, so the flow between dates, we can compare it with an estimate that we do in the ICMA survey. We calculated 2.3 trillion per day. The SFTR survey at the end of the year came to about 3.5 trillion. So we have about 62% of the turnover. So again, a pretty good coverage. If we look at the trading analysis, then the clearest trend there is the green line. There's been a secular decline in the share of voice brokers over 20 years, but that's been interrupted periodically, usually during a crisis. So during the great financial crisis, and then more recently, we see the share of voice brokers level out a bit. Now, we may or may not have reached the floor for the share of voice brokers, but the recent resilience of that share is probably due to the fact that in difficult market conditions, voice brokers can offer support to price discovery. But over that 20 years, we've seen the composition of voice broking business shift from general business to more specialist, longer term or forward repos where they can add value, and the short term end of the repo market being almost entirely occupied by electronic trading. Electronic trading is shown in the blue line. This is automatic electronic trading, so it's BrokerTec, Eurex, MTS, and TP ICAP. And it would appear that that is suffering a bit of a downturn, but this is only the share. The fact is that electronic trading is increasing steadily, but on occasion it's outpaced by growth in other sectors. And in particular, if we look at the red line, that's direct trading. This is really where all the interesting stuff is. So customer business, long-term, structured, credit repo. And that grew quite steadily from the time of the Great Financial Crisis, but has leveled off for the last few years as a share of the overall market. But of course, the overall market was growing. And then tri-party has essentially fluctuated around 10%, but after the expanded asset purchase program, it declined to a low of 6%, from which it started to recover. But tri-party will be pinned down at that level by continued central bank liquidity for some time. I should note that the crisis itself, the COVID pandemic crisis, was initially good for tri-party. It recovered a bit more ground. People were dashing for cash and tri-party was a way of getting it. But the subsequent central bank intervention has reasserted the picture that existed before. If we look at the blue number is the survey, the sort of browny yellow number is the size of tri-party reported to us directly by the principal agents in Europe. And we can see that after the Great Financial Crisis until 2015-16, tri-party, the universe of tri-party as reported by the agents, outpaced the survey, but then subsequently the survey has outpaced tri-party. Now, the picture is slightly distorted by the fact that the tri-party numbers reported by the agent include the global business of one of the agents, but the outperformance may also reflect the fact that the number of participants using tri-party has expanded. Members of the survey tend to be well-established banks who have been involved in tri-party for some time, but others have been joining that market. And then from 2015, we see tri-party really following that flat trend. Again, that's central bank intervention really reducing the need for GC financing of all sorts, including tri-party. And to go back to electronic trading, that's this is the absolute share of electronic trading, automatic electronic trading, reported to us by the principal trading platforms in Europe. And you can see there's a clear upward trend there. Sometimes it outpaces the survey, at other times it underperforms. More recently, it's been underperforming. And then, of course, we get the COVID panic, and you see that sharp spike at the end. And that is the contribution of COVID to a bumper period for automatic electronic trading. But things have come back down by the end of the year. I understand they may well go up in the first half of this year, but really back to normal to some extent. Now, if we compare 2020, the red line is BrokerTec, so the major automatic trading system for repo in Europe. And then the blue column is an estimate of the European repo business of Tradeweb. And what this tends to show is that the automatic systems did well in the first half of the year on the back of COVID, but have tended to fall back. Whereas we know that prior to August, the European share was slightly lower than we see for the second half. The effects of the COVID crisis have had a beneficial effect on automated electronic trading of the sort done by Tradeweb, so RFQ systems, but that has taken some time to feed through, presumably because of the lag in onboarding. And then in geographical analysis, over the whole survey period, we see domestic, the share of domestic trading declining until about 2015, reflecting probably structural reorganization of the repo business in Europe. And then it flattens out, and we see there appears to be a trade-off with anonymous trading. So this is CCP cleared, largely electronic trading. There appears to be a trade-off, but I think that's probably illusory. or coincidental, and anonymous trading appears to be falling away, but that is only the share of anonymous trading is just being outpaced by the growth in other forms of trading on the European market. Cross-border business is the bulk of trading, and it's been more or less steady over the whole 20 years. If we break down cross-border business, unfortunately, we can't, because of the limitations on the data that's provided to us, we can't say where business comes from and goes to. We can only say where it goes to. And if you look at the blue line, which has been on a downtrend over the survey period, this is cross-border business that's going outside the Eurozone. So it may well be from one non-Eurozone European country to another non-Eurozone European country, or even outside the region, or it may be it's entirely outside the Eurozone. The red line cross-border into the Eurozone, so that could come from one Eurozone country to another, or it can be from a non-Eurozone country into a Eurozone country. So I'm afraid that's all we can really show, but clearly that cross-border business of both forms is quite critical to the market. One interesting statistic on CCP cleared automatic trading, anonymous electronic trading, is that due to withdrawal of a particular counterparty in the Italian market, virtually all electronic trading on automatic trading systems is now CCP cleared, so 99.6%. Currency analysis. So the euro's declined over the 20 years, partly as a result of central bank intervention at various phases, particularly recently, but also because of diversification into other currencies. So the dollar now plays a larger role than it did originally. Sterling has increased its share, and there are other currencies, particularly Asian currencies, taking up a greater share of the European market. In terms of collateral, there has been an uptrend in government securities. So in the early part, first half of the survey, really, we saw diversification out of government securities into credit repo. That was really put on stop by the crisis. And then more recently, there's been an increase in government security share of European repo, probably due to the attractions of those securities as HQLA. And there's been a significant increase in the latest survey. So in terms of core Eurozone securities, the German securities, which have been on a secular decline due to their safe haven status and also until fairly recently reduced issuance, suddenly rebounded, and the same for French securities. And the increase in demand for government securities in this instant, or so in the latest survey, to a large extent reflects rapidly increased issuance by both of those countries. And when we come to look at peripheral Eurozone in the next slide, we'll see the effect of slower issuance in Italy. So Italian securities, when we started the survey, they were almost synonymous with European GC, so 18% of the market, and dropped to a low of almost 7% after the crisis, rebounded partly due to relaxation of fears, credit risks surrounding Italy, but also the search for high yield, but a sharp downturn more recently. And in terms of the December survey, that's due to reduced issuance over the period since the previous survey. So this is the maturity analysis. Each cluster of columns is a maturity bucket. If you look for the red columns in each cluster, they're the 2020. And what we see there is that there has been an increase in 2020 in 1 day to 1 week repo, and various times reduction in the rest of the short dates out to 1 month. But notably, from 1 month to 6 month, there have been significant increases. And we associate that 1 to 6 month business with collateral transformation, particularly at year end, into HQLA. I'd also draw your attention to the very high levels to which forward repo have got over the survey, which we attribute originally one would have been using forward repo for interest rate positioning, but in current circumstances would appear to be a collateral management tool, people anticipating future difficulties in either acquiring or providing collateral. And this is a net reverse repo, and what I'll draw your attention to is the red columns are 2020, the brown and orange columns are 2019, and there's been a flip to a negative gap in the repo market over 2020 as opposed to a positive gap in 2019. In other words, the repo market is now, the sample at least, is borrowing short and lending long to the rest of the market, whereas in 2019 it was the other way around. And then we can see that in a different way. Red is repo and blue is reverse repo, and you can see the flow of cash, and of course collateral flows the other way. If we look at the components of maturity analysis, we see very sharp seasonal variations in short dates. So short dates drop in December and they increase in June. At the year end, people want longer term financing. If we look at 1 to 6 months, the seasonality is even more apparent, but it's the other way around. It increases in December and declines in the June survey. And then these are estimates of the maximum minimum weighted average maturity. We were on an upturn that was interrupted by COVID in June, but we appear to be back on trend. So lengthening average maturities in the repo market. And then final slide, we ask how much securities lending is done on repo desks. So this gives an indication of the convergence of the two markets, and that is starting to come back up, possibly driven by collateral transformation requirements. And that's it, Godfrey. 40 surveys, 20 years, and that's all we got to show for it.
Thank you, Richard, for always giving us insight in what we are doing and also helping the regulator to understand that this market is very important for the well-being of Europe. And that brings me to the next intervention. You know, for more than 20 years, we as a committee have been discussing with regulators at large, but particularly with the central banks. And when the European Central Bank created the euro, of course, the virtual euro, as we can say, was there before we got the coins in our hands. And so all those years, we have discussed clearing and settlement, the bottlenecks of Europe. And with the great help of Frankfurt, you know, we have made progress. Gertrude Thunberg-Guggerl, who was in consultation in Brussels, said we're going to do target securities. You know, we want to be the catalyst. We're still working on that, right? This is a project that will, I don't think, ever will end. But in all those years that I've been involved and the committee has been involved, we met people in Frankfurt. And of course, we all grow older, but you also become wiser. And sometimes you're not even wiser than you think. But then one of the person that I always liked in Frankfurt was Fiona, because Fiona was there in the beginning, you know, and then she moved up, and now, congratulations, you're Deputy Director General, DG Market Infrastructure and Payments. And I asked you a few months ago, would you give your feedback on what's happening in Frankfurt? How do you see things? And where can we be better as a market to help the ECB to create this unique currency for the Eurozone? Thank you.
Good afternoon. I'm very pleased. Thank you very much, Godfrey, for the very kind invitation. And I'm happy to have been invited to give the keynote speech at today's European Repo and Collateral Council AGM. It's actually been a few years since I was directly involved with the activities of the ERCC. In fact, the last time I think there was only one C in the title of the group, but I definitely have an affinity with the topic of collateral, so happy to see it up front and central. And I'm honored to speak today. So let me start. We live in a complex world. Usually we do not have too little information, but rather too much. And navigating this information is time consuming. We are often at risk of getting lost in details. Thus, at times it's useful to take a step back and to focus on our main goal. And based on the ECB's responsibility for promoting the smooth operation of payment system, this goal is the creation of a truly single financial market in Europe, where payments, securities, and collateral move safely and efficiently between market participants in different countries, and where the risks and the costs associated with financial transactions are not affected by the location of counterparties. This, in a way, is our mantra, a kind of magic formula, some might say, that should help keep us to stay focused. And we see this on the slide that's on your screen that portrays the magic triangle in terms of the cash, the securities, and the collateral legs. And I will go more into detail on this during the course of the presentation this afternoon. So with this goal in mind, I will discuss today how the Eurosystem supports the market in its aim of centralizing liquidity, in particular when it comes to the use of such liquidity for settlement in central bank money. I will review what has been achieved in the harmonization of European securities and collateral markets, and this through a combination of regulatory measures, market-based harmonization initiatives, and the development of the Eurosystem's own market infrastructure. And I will highlight the areas where further action is required and where I believe that further gains can be made. So The first part, a truly single financial market in Europe. In the efforts for the creation of a truly single financial market in Europe, we can see two forces at work. The first one relates to the flow of payments, securities, and collateral, and the second, the combination of market harmonization initiatives, regulatory measures, and Eurosystem market infrastructure development. Put together, these two sets of forces should bring us towards our goal. And the better entwined the working of these two, then the better the process will be in the end. Now, in the years prior to the introduction of the single currency, pre-1999, for those young enough not to have worked through the experience, Euro area countries developed their own standards and infrastructure for payments and securities transactions, with the aim of meeting domestic needs. So at the outset, the euro had to cope with a number of frictions and inefficiencies as a result of the relatively diverse and fragmented nature of its markets. Now, the introduction of the euro itself has served as a catalyst, promoting efforts to reshape, to harmonize and integrate business practices and standards in the European financial market. With the removal of currency segmentation in the euro area and the globalization of financial activities over the last 20 years or so, European financial markets have undergone significant changes and have seen considerable structural developments, becoming far larger and more liquid as a result. Market stakeholders have been playing a very decisive role in the harmonization and standardization process. Their commitment is crucial to ensure that the development and implementation of standards and harmonized business practices best fit the actual market needs. The Eurosystem itself has also been supporting this process by acting as a catalyst, organizing stakeholder fora with a sound governance structure to make sure that all relevant stakeholders are adequately represented. Still, market self-regulation has its limits. Particularly if it comes to addressing legal barriers, the contributions of a regulator, either at European or at national level, becomes necessary. Some of the obstacles blocking the path to a truly single financial market in Europe are based on legacy rules and diverging national laws. This is why the continuous dialogue with the European Commission is very important for market stakeholders and for central banks of the euro area, the Eurosystem. And in this respect, the Eurosystem supports the European Commission's goal to stimulate the openness, strength, and resilience of the EU's economic and financial system, which is based on three pillars. Firstly, promoting a stronger international role of the euro. Second, further development of EU financial market infrastructures. And third, the uniform implementation and enforcement of the EU's own sanctions. Now, without prejudice to the ECB's own independence, we welcome the Commission's support for our initiatives on market infrastructure and payments, which help to increase efficiency and financial market integration in and across the euro area. And as a major market infrastructure provider, the Eurosystem has been substantially contributing itself to a truly single financial market by integrating and consolidating the infrastructure for large value payments, for post-trading services for financial instruments, and most recently in the area of instant retail payments. Target 2 and its predecessor are the longest standing components of the Eurosystem's financial market infrastructure. Today, Target 2 is one of the largest payment systems in the world, and it processes 90% of the total value settled by large value payment systems in euro. Target 2 Securities, a platform that I'm sure is well familiar to members of this group, processes the real-time settlement of securities transactions against central bank money across Europe. It facilitates the establishment of a single pool of collateral for banks and intermediaries to settle their entire European business in central bank money, thereby optimizing settlement and tri-party procedures. And last but not least, the Eurosystem operates Target Instant Payment Settlement, a service for pan-European instant payments with settlement in central bank money. And by the end of 2021, all payment service providers in Target 2 that adhere to the standard which has been established by the European Payments Council for instant payments will become reachable in TIPS, helping to make instant payments the new normal in an increasingly digitalized retail payments ecosystem. And still in the securities market, the issuance and distribution of securities still hinges on fragmented legacy standards, structural constraints, and complex market practices at the national level. Now, with the support of the industry professions in what we call our Debt Issuance Market Contact Group, DIMCG, The Eurosystem is analysing the inefficiencies, the potential harmonisation proposals and market solutions in the area of primary issuance and initial distribution of debt in the EU, focusing primarily on supranational issuers. And the DIMCG is expected to publish its report in Q4 of this year. And after that, the ECB decision-making bodies may consider any further steps in this area. Moving on, I would like to speak a little bit about the centralization of liquidity in central bank money. Enabling greater and more fluid movement of payments, securities and collateral across Europe is a key factor in optimizing market participants' liquidity management and allowing them to centralize their liquidity in central bank money. To support this goal, the Eurosystem is further developing its own market infrastructures. And we have two major projects here, which are expected to go live in the next few years, namely the T2, T2S consolidation and the creation of the Eurosystem Collateral Management System, ECMS. The upcoming technical and functional convergence of Target 2 and T2S will further optimize liquidity management and generate new cost efficiencies for market participants. ECMS, on the other hand, will replace the individual collateral management systems currently in use by Eurosystem national central banks. Counterparties, central securities depositories, and tri-party agents in different countries, which today interact with national central banks through their own national collateral management systems, will in future be able to use the same and single harmonized system. This, of course, will simplify processes that involve multiple jurisdictions, notably the mobilization of cross-border collateral as one of the main processes in this respect. Although ECMS is ultimately a service to support collateral management in the context of Eurosystem credit operations, the efficiencies and harmonization that it brings to this area will support more streamlined flows of collateral across central bank operations and private market operations. Now, following requests from the European financial community, the Eurosystem reviewed the timelines of the T2, T2S consolidation and the ECMS projects in the course of last year and rescheduled the projects to November 22 and November 23, respectively. Now, these decisions were taken in the light of the challenges posed by the COVID-19 pandemic, which I think everybody can well appreciate, and the rescheduling of another major market initiative related to ISO 20022. But all this taken together means that by November 2023, we will have the three cornerstones of the magic triangle I spoke about earlier for the free flow of payments, securities, and collateral even more fully in place. We will have T2S for securities, T2 and TIPS for payments, and ECMS for collateral. And at the center of these three cornerstones, there will be what we call a main cash account. And this is quite an important feature, and I'd just like to take a few moments to talk a little bit more about that. So this main cash account will enable centralized liquidity management and control over the payment capacity of a particular institution, with a clear allocation of liquidity for the different settlement purposes. Real-time gross settlement participation will be segregated from interaction with central banks for monetary policy purposes. And the minimum reserve calculation and automatic marginal lending facility will take into account balances in other Eurosystem market infrastructures, such as T2S or TIPS. So in summary, therefore, the MCA, the main cash account, will make the use of central bank money even more efficient for market participants. And this is one of the key features of the new consolidated T2, T2S platform. Now, as the optimization of settlement efficiency stands at the center of the following panel discussion, I will only briefly comment on this topic here. You can expect, however, that the Eurosystem, together with the T2S CSDs, constantly monitors the efficiency and effectiveness of the T2S platform settlement engine. Dedicated workshops regularly take place with the T2S market in order to improve the understanding of the T2S settlement performance and to identify and to address possible hindrances to settlement efficiency. Recently, this analysis has focused on discussing a measure of settlement efficiency in line with the guidelines on the settlement discipline regime under the CSD regulation, the CSDR, in order to support CSDs in their preparations. So in this context, I would like to add that the Eurosystem, of course, also appreciates the work and input by the ERCC, in particular on analysing how repo transactions could settle even more efficiently, more safely, and ideally even earlier during the business day. So moving to part 3 on securities and collateral harmonization. So in conjunction with the CSDR, the launch of T2S itself has been a catalyst for harmonizing the post-trade market in the EU. Faced initially with a wide variety of different practices across European markets, the T2S governance structure fostered collaboration between stakeholders. The integration of ancillary processes and legal frameworks significantly streamlined cross-border settlement procedures, both for CSD participants and their clients. In the narrow sense, the harmonization agenda on securities settlement is close to completion. T2S markets have reached a high level of compliance with the T2S harmonization standards. The most challenging harmonization area at this stage remains corporate actions, which probably does not come as a great surprise to members of this particular group. In December 2020, the Corporate Events Group, a dedicated pan-European group with broad and balanced representation of markets and industry groups, published its first corporate events compliance report. And the compliance assessment survey revealed a very high response rate, with ICSDs participating for the first time, thus helping to provide a more comprehensive picture. Ensuring an appropriate level of involvement of all relevant actors, improving the quality of information provided in the self-assessment exercise, and assisting markets in addressing challenges they may face in achieving full compliance via a sponsored system are expected to close most of the remaining gaps in this area. On a more critical note, however, it's noted that despite the harmonization efforts, there's been no significant increase in competition or cross-border services or even cross-CSD settlement over the last years. And we have some slides here to support this. Issuance, for example, has a strong home bias, and this has been clear for many years. We've taken snapshots from the Eurosystem's eligible assets database, which suggests that the issuer's country of residence is the same as the CSD's country of residence in around 70 to 74% of all issuance, with no clear trend emerging since 2015. Furthermore, data that we've collected in the ECB's securities settlement statistics show that the value of securities held via CSD links in EU CSDs have remained stable since 2010 at around 21 to 23% of all securities balances. And this is a very modest figure, which we had expected to generally increase over the years. However, this has not been the case. Looking forward, however, there is potential for advancement in this area. The review of the CSDR is ongoing. The Shareholders' Rights Directive 2, SRD 2, and the expected European Commission action on withholding tax procedures. All of these are expected to provide momentum towards more competition. Furthermore, the closer integration of the ICSD ecosystems with T2S will benefit all stakeholders, in particular issuers and end investors. In the long run, better integration and more efficient settlement in central bank money, regardless of whether this is achieved via ICSDs joining T2S or by using T2S to improve and consolidate CSD service offerings. In the area of collateral management harmonization, we have the development of a single collateral management rulebook for Europe, which we call SCORE, and this is already underway. The work on this also benefits from the contribution by the ERCC members who participate in our advisory group, the AMI-SECO Collateral Management Harmonization Task Force. And implementation of the SCORE standards for tri-party collateral management for corporate actions and billing processes has started. So this is really quite positive progress in this area. These standards rely on the usage of ISO 20022 messaging. Adoption of ISO 20022 messaging will continue to be at the forefront of further harmonization work in the remaining 7 areas of collateral management that remain to be included in the SCORE. The objective, however, is that by November 2023, at least the tri-party standards, the corporate action standards, and the billing standards will have been implemented by all relevant market stakeholders. In parallel, the Eurosystem has been harmonizing the process for managing the collateral mobilized for Eurosystem credit operations. This work has been a key pillar for the development of the Eurosystem Collateral Management System, ECMS, that I mentioned earlier on. And the Eurosystem has ensured that these processes are compliant also with the relevant market processes. So let me conclude here. In its provision of safe and efficient financial market infrastructures, the Eurosystem plays an integral role in working towards a truly single financial market in Europe, where payments, securities, and collateral can move safely and efficiently between market participants in different countries. The consolidation of Target 2 and T2S and the mobilization and management of collateral through the development of the ECMS are two of the cornerstones of the Eurosystem's ambitious agenda up to the end of 2023. In conjunction with legislative action and market-driven standardization and harmonization measures, we will make a joint effort to close the remaining gaps. To this effect, all relevant market stakeholders, including many in the room here today, are called upon to implement the agreed standards in a timely manner. I thank you very much for your attention.
Thank you, Fiona. As always, interesting, I think for some, even would say passionate, the way we look at this. But as you know, there's much more work to do, and we are ready to do that. And I'm very glad to have the next panel chaired by Alex Westphal, who is our never stopping to work ERCC secretary. He also was very instrumental to coordination SFTR, which was a congratulations on that. But now let's discuss how can we optimize settlement efficiency to prove to the regulators at large that yes, we as an industry, we can do better and we will do better.
Thanks, Gottfried, for the very kind introduction, and good afternoon, everyone, and welcome to the second panel of the day, where we will discuss, as Gottfried mentioned, the challenges around settlement efficiency, and it's also a good opportunity to provide a bit of an update on our ERCC work around this topic over the past months, which has been quite extensive. So I think we will put a very good panel together to do that. All the panelists have been very involved in our ERCC work on this topic, and then also we have a good range of different institutions on the panel and perspectives. So very much looking forward to an interesting discussion. So let me briefly introduce then the panelists. First, of course, Gareth, who has already been introduced as ERCC chair. I'm also joined by the two ERCC Ops co-chairs, Nick Hamilton, Executive Director at JP Morgan, and James Upton, Commercial Services Director at LCH Limited. Then we also have Rebecca Carey from Euroclear Bank. And last but not least, Simon Squire, Head of Product Strategy, Clearance and Collateral Management from BNY Mellon, also both involved in our work. So let's get started with perhaps a basic and very obvious question to the panelists. Why are we actually looking at settlement efficiency? Do we think we have a problem with settlement fails in Europe? I mean, regulators certainly seem to think so. If we look at the rather drastic measures of CSDR. But what's your view? Is there actually something to gain for the industry from this work beyond purely anticipating the impacts of CSDR? Perhaps, Rebecca, should we start with you from an ICSD perspective?
Yeah, well, in fact, as a product manager, I'm in charge of transaction processing for Euroclear Bank, also for ESA CSDs. So you can probably imagine that actually settlement efficiency for me is something I think about all the time. In every project or initiative I've worked on could be measured in some way to do with whether it would improve efficiency or decrease risks while still maintaining efficiency. So for me, it's really, it's really my bread and butter, the main thing we think about. Like you said, Alex, this isn't a discussion about CSDR, but nonetheless, I think, of course, I've been worrying about settlement efficiency for years, but CSDR has definitely brought a new focus on the topic. And I see that plenty of our participants in the industry are able to really mobilize resources now to really look at efficiency and the problems. And so I think it's not that we need to, this isn't the CSDR topic, but it's definitely giving us it's the right time to be looking to, it's kind of the opportunity, I think, to try to solve some of these problems. So your question was really, do we have a problem? I think maybe it's useful just to share a few high-level numbers about where we see efficiency in the efficiency levels in the European markets. So I think the headline rates, settlement efficiency for debt instruments in Europe, I see numbers ranging 94% to 97%. And you might ask, well, Rebecca, can't we have one number? But actually, it's actually quite difficult to know how to give a correct number. I think Fiona just mentioned before that there's been some work going on with the ECB to come up with a number that would be related to CSDR. But the point is sometimes it depends on what you want to use that number. So whether you would include late instructions or collateral movements. So what I'm saying is it can make sense that you have a range because it depends on what you're looking at. But whichever method you use, I think there's certain trends that come out regularly anyway. So the settlement efficiency depends on the asset type. So the ECB shared a settlement efficiency for government bonds of 97%, but 94% for other debt securities. Looking at Euroclear bank data, I can also see that the fails rate for corporate bonds is twice as big as the fails rate for sovereigns, supras and agencies. So you really have a big difference depending on the type of security. You also generally see a link between total volumes and efficiency, but it's not a correlation. So of course, this time a year ago, we were right in the middle of the COVID crisis. Well, to some extent we still are, but we saw transaction volumes increasing by 50%, but actually the volumes of fails doubled. So it was a much bigger increase. But then later on in the year, we still have other big increases in volumes and we don't have such an increase. So what's important is we need to get the right numbers and also really see the combination of factors. So I think that's what we're trying to do with looking at the different data relating to settlement efficiency and seeing how we can make sense of that and get the right sort of insights out of it. But generally as well, so I said possibly a 97% efficiency rate, but you should see that as a 3% fails rate. And it's a 3% fails rate, but depending what business you're in, it could be a 5% fails rate. And in stress conditions, that can be a 10% fails rate. I think those are big numbers. And so just based on those numbers, it certainly seems to be the case that we should take the opportunity with CSDR to try to address that right now.
Thanks, Rebecca. No, I think it's really useful to provide that baseline. Nick, perhaps over to you next from a dealer perspective. Also, perhaps providing a little bit of a view on what's behind the fails that you see.
Yeah, well, I think Rebecca's points around the actual settlement efficiency, are applicable across a number of the channels within the marketplace. I think it's worth noting that whilst it sounds quite high in terms of 97%, and what that represents in terms of absolute numbers every month is still a number in the tens of thousands in terms of fails across the capital markets and equities within that range. So it is a meaningful and sizable challenge for the industry today. As a sitting in the operational role with JP Morgan as a broker dealer, and having managed both at a production level and more recently looking at some of the strategic change within the area, then there are a number of kind of elements which I think are visible to many of us in terms of drivers of that 3 to 6, 7% that kind of Rebecca's referred to. Then there's a meaningful population of unmatched trading activity, which generally manifest themselves, as unmatched trades. I mean, we're fortunate in Europe that we have transparency in terms of settlement statuses, and we can't say the same, in terms of kind of global inventory. So I think we're relatively self-aware in terms of the event management, the sequencing activities. And of that delta of fails, then maybe approximately 15-20% of them are due to unmatched trades coming into value date, and there are technical and reference data driven warehousing kind of work that's kind of working its way through to, I think, help cure and improve the quality of the inventories coming into value date. But I suppose where it gets interesting for us in the repo and collateral space is in terms of some of the relative size of the fails and the actual positioning of the assets, and looking at for a broker dealer perspective, where much of the book is kind of match book in terms of delivery and receipt. We can see some real materiality in terms of the sequencing and the timing of those inventories coming into value date and beyond. And I think that hones into the drivers of I think of what we'll be talking about today, in more detail in terms of the symmetrical relationship that we need at a market level between the market participants, in terms of the broker dealers and the buy side, the outsourcers and the custodians, into the market infrastructures as well. I'm sure James will talk to this shortly as well, so that we can deliver efficiently across those chains. And really trying to focus on how we can establish symmetry in the market today from a position and trade perspective. And I think what we'll hopefully explore today is perhaps some of the sort of lenses that we can want to apply on this in terms of how we can put that symmetry back into the flows.
Thanks, Nick. Perhaps, before we come to James, perhaps first to Simon from a custodian perspective. So how do you see the challenge around fails?
Yeah, look, I'd probably think about this in terms of highlighting some of the benefits for the broader industry. So firstly, I think enhancing settlement efficiency should help reduce the intraday liquidity profile for the industry. We'll talk through some of those techniques later, but clearly that would be a really good outcome for us. And then the other two areas I'd highlight around cash and inventory management. So taking the cash leg first, at risk of stating the obvious, fails cause cash management challenges. If you're projecting to receive cash, when that trade fails, you might now need to raise cash so as to not be overdrawn or be short cash at the end of the day, and vice versa. If you're expecting to pay out cash when that trade fails, you're now potentially looking for ways to place or invest that cash that you just weren't expecting to have. Of course, all of this is compounded by the fact this can happen quite late in the day, which can cause further complexity and inefficiency. So enhancing settlement efficiency will enable more effective cash management. Then flipping to the security leg, ultimately when a trade fails, there's an asset in quote unquote the wrong place. And that's not likely at that point to be used for another purpose. So in a secured financing transaction or to cover another collateral obligation. And this effectively increases the cost of carry or financing costs for that institution, as they now have an asset that they just weren't expecting to have in their inventory. So again, enhancing settlement efficiency has a broader benefit to more effective inventory management. So, in short, I think there's some real benefits to be gained here for the industry across intraday liquidity, cash, and inventory management, to name a few.
Thanks, Simon. And then James, from a CCP perspective, it's of course something that came up in the committee specifically.
Yeah, there's already so many perspectives, isn't there, Alex? And so many of them are so valid. I think, from my standpoint, firstly, it's important to take a step back and recognize that unlike other regions such as the US or the UK, Europe is unique in the amount of choice that it gives to users in terms of how and where they can settle. I think Fiona explained that Europe has T2S, and T2S has got an increasing number of investor CSDs broadening their remit to allow an increasing number of securities to be settled within them. It's also got two prominent ICSDs, Rebecca's here, that are critical in terms of their user base, but more importantly, the role they play in international settlement and also tri-party funding. Now, from my perspective, from the CCP's perspective, that choice is of course very, very welcome, but what it can lead to is a fragmented landscape in terms of capabilities, the tool set, and also for this panel, I think the consistency of settlement practices. Therefore, I think Fiona referred to harmonization. That is really, really key, and a broader adoption of the tools that are available can and should be used by a greater percentage of the market. I think, speaking from a CCP perspective, so CCPs take settlement incredibly seriously, and I really want to emphasize that. But it's also important to emphasize that CCPs naturally add a huge amount of value in the settlement efficiency process. As Alex, you said, I'm at LCH and I work within our RepoClear service, and we typically clear around €1 trillion worth of government bonds a day across our European and UK debt markets. It's a really sizable number. But because RepoClear nets activity down to the smallest possible settlement per security, per member, per day, what we instruct each day is typically a lot less than that €1 trillion. Now, on what we do instruct for settlement, we typically see fail rates of perhaps between 2 and 3%. That is probably a little bit less than what you would expect to see in the uncleared market. But what we unfortunately do also see are some users who are consistent and persistent failures into the CCP more so than others. And that then has a big impact on we in turn can deliver out to the rest of our members. So That's the reason why, from a CCP perspective and from an LCH perspective, we really support the ERCC recommendations, but equally we will be independently looking to strengthen our fail management toolkit and toolset to drive even greater settlement efficiency at the CCP.
Okay, thanks, James. And we'll come on to those recommendations in a minute. But before that, I hand over to the chair to wrap up that question. Gareth.
Yeah, to me, on the topic of, you know, do we have a fails problem and are there really target levels? I think the first thing I want to say is I don't think we can ever fix fails, right? You know, we can't be perfect. You know, unless we had a complete redesign of the whole of the global infrastructure for securities markets, you know, and you see many of the technological initiatives out there trying to help in this space. So I don't think we can be perfect, but I think one of the most important things to think about is we need to ensure that we've got functioning financial markets, even in the times of stress. You know, repo and collateral are at the heart of creating liquidity for all financial participants, and no institution ever wants to be in the situation where fails are actually impacting their institutional survival. You know, that's paramount, and why it's also why it's such an important topic. You know, so it means we do need to get better, right? And I think that's exactly the purpose of, you know, regulations like CSDR, right? It needs we need to put in place better procedures and change the way the market works and what the standards are, and challenge how it's been done in the past as well, right? Which is one of the reasons we had this big workshop a few weeks ago to talk about this topic. And so as an industry get together and discuss what the way forward is, and also the output being the recommendations that we're about to talk about and the principles.
Okay, thanks Gareth. Okay, with that, let's indeed come on to our discussion so far within the ERCC and also concretely the agreed recommendations. So we had the discussions in the committee, and also, of course, a lot of work done in ERCC Ops over the past years. James, can I ask you perhaps to provide a bit of an overview what we've done so far, and then also concretely what, you know, the conclusions have been at this point?
Yeah, thanks. I think it's a really good opportunity to highlight the ERCC, the best practice guide. I think the latest edition came out today. A lot of the referrals to these recommendations are in that best practice guide. I actually saw it on my LinkedIn feed before I logged on to today's session, so it is now live. So I would encourage everyone to please take a look at it, and I'm sure that, you know, Alex can certainly share it more broadly as well. I think as we thought about the recommendations, what came across that it really is truly an industry effort. And we do also want to work with other industry associations to ensure that we're consistent in our approach, and to think about the recommendations in terms of both, as Simon mentioned, intraday liquidity, as well as the core topic of settlement efficiency. Equally, we've engaged a very broad cross-section of the market to understand their relative capabilities, and that cross-section has included dealer banks, the buy side and their custodians, prime brokers, CSDs and ICSDs, and of course CCPs. I think, you know, the conclusion to that point is that settlement and settlement efficiency impacts the entire market, a huge cross section of the market. So we've come up with a list of recommendations which I'll now cover. Important to highlight that the recommendations are not mutually exclusive. We see each of these recommendations as being part of a much broader tool set of solutions for the market. So in terms of the recommendations, they're on your screen. Firstly, shaping. The best practice recommendation is to settlements to be shaped into 15 million nominal shapes. Many firms, such as CCPs, including my own firm LCH, we do this today, but the ask is for this to be more broadly adopted across the market. I think additionally on shaping, a further medium-term recommendation is that it should apply on a mandatory and automated basis in Europe, in a similar way that it does today in the US. Now, this is, of course, an industry effort to implement. There are different ways of doing it. You could either do it in the front end at the settlement at the trade booking, or you could do it at the settlement layer at the infrastructure level at the CSD or ICSD. That needs to be discussed and be decided. But the medium-term goal, I think, for us is to have that done on a mandatory and an automated basis with the relevant regulatory and industry support. The second core recommendation is around auto-partialing. Now, it's best practice today, as you'll see in the guide, for a firm to use auto-partialing where possible, but there is a further point for all participants to develop the technical, operational and account structure capabilities so that auto partialing can be used more broadly today. The third recommendation is around auto borrowing. Now, the recommendation is that CSDs should offer auto borrowing programs to their participants, and that participants should make use of them. The auto borrow programs, they must be used in a way that is commensurate to a firm's level of activity. You must use it commensurate to the size of activity that you are executing and your settlement activity. CCPs should have firm rules and requirements in their rule books for members to be part of those programs, but equally they should work very closely, and the CSDs and ICSDs should have the authority and the capabilities to police the use of these programs to ensure that they are being used appropriately and commensurate to a firm's level of activity. In terms of the fourth recommendation, I spoke earlier on around CCPs kind of really just increasing their firm management escalation frameworks, but equally there's an element of operational efficiency, so making sure that booking practices ensure that trades are booked accurately and that that's not leading to kind of further unnecessary settlement fails. So really just to summarize, you've got four recommendations: the first around shaping, the second around auto partialing, the third around auto borrowing, and then the fourth general recommendation around CCP rulebooks, and a further focus on general operational elements and booking accuracy.
Okay, great. Thanks, James. That was a useful overview. Nick, as second co-chair of the ERCC Ops, given that the Ops had quite a leading role here. Anything to add?
Well, I think if we looked at it as a use case, further to the comments made earlier, then I mean, we are thankful in this current environment that we are kind of relatively data rich in terms of our observations, and that at an institutional level, many of us are observing the impacts of non-adoption of these activities on a periodic and in some cases quite a frequent basis. So, and if we took an example whereby an intermediary is trading some GC, in terms of bilaterally, in terms of 250 million bonds, with a client counterparty where, and again, it's not unusual in terms of that size, and where you've got maybe an outsourcer and a custodian involved, away from the kind of more proprietary elements on the broker dealer flows. If those trades aren't shaped at source on execution, then if there's any issues on value date in terms of the receipt and delivery of those bonds, then it makes it very challenging to be able to reposition any changes, any reduction in terms of partialing and agreement of then to onward deliver those into the match book and the settlement chains. And the other side of that, to James's point earlier, could be the CCP or another broker dealer. And given, as again was highlighted, that the fact that we've got to issue a CSD, T2S investor CSD, and an ICSD chains here as well, then any break in that inventory is become challenging to actually move that through. So if you look at the sequence of events that James has described, then the shaping kind of helps reduce that kind of risk of large trade fails into the processing. The partialing further automates the positioning of inventory through the day, and as a backstop, and this is quite visible, I'm sure, for many of the dealers present, then we've got an auto borrowing capability which can kick in both on the intraday and end of day to facilitate the overnight settlement. And actually, what we might see is that settlement efficiency rates, maybe in some respects kind of artificially high, because we've got if you're looking at core symmetrical settlement, because there's a heavy reliance on the auto borrowing services, which are great to have as a backstop, but in some cases are probably used more than they should be to be able to support to market efficiency, and away from boxing inventory and over collateralization to ensure settlement. So these proposals really do address kind of some of the fundamentals in terms of the inventory management, and again ensure the symmetrical settlement across the market flows.
Thanks, Nick. So that sounds all very, very good and logical, of course, but that brings us then, of course, to the big question: why are these tools not more widely used yet? And why are we even still talking about this? So what are the kind of the key obstacles still in the way? Perhaps Simon, first of all, from your perspective, of course, the kind of the technical constraints at the custodian level were mentioned quite often. So can you just explain a bit?
Yeah, so I mean, in terms of constraints and implications, clearly through CSDR and the work done by ICMA and the ERCC, we're on a good path forward. But the work done to date has highlighted some practical considerations that we'll continue to work through. So to touch on a few, there's an interesting challenge relating to the use of omnibus accounts for partial deliveries. So there's some work we need to do there. There's obviously the kind of question of additional costs associated with creating more transactions. I think, the association has received some comments on this point. Interestingly, I think it's worth noting here that potential additional cost is variable for partial settlements of trades. It's just not known how many partials might occur on a given transaction. Ultimately, however, on this point, I do believe, as per my earlier comments, that if we increase settlement efficiency, then overall costs in the marketplace should reduce, and all things considered, we should end up in a better situation. Moving then onto a different use case, intermediaries acting on a matchbook basis may find it difficult to shape and partial transactions, as both sides would need to agree, and time is often limited due to currency and funding cutoff times. And then the last thing I'd kind of touch on is investment funds may face conflicts with their mandates and business objectives, for example, minimum allocation sizes as an example. So look, there are a few examples, and I think gives a good idea of some of the practical information considerations we're going to need to work through as a group.
Thanks, Simon. And then Rebecca, from an ICSD perspective, I mean, you have, of course, the best view on, take up, especially, of course, when we talk about auto partialing and auto borrowing. So what do you see as the key constraints here, obstacles?
Well, maybe first, just picking up on the point about auto partial. First, maybe on the T2S side, this is a standard feature in T2S. And it was implemented in the ICSDs relatively recently. But in both T2S and ICSD environment, we offer the possibility to opt out of partial. So the receiver, the person receiving securities, also has to agree. So this obviously can make it more difficult in terms of adoption, because both parties need to agree to do that. But on the other hand, this optionality was something we also thought was very important, because it allows a gradual adoption. And I think that was very important for some participants, because actually using auto partial implied quite a big IT build for some of the industry and for some participants. So the optionality would allow to slowly take it up. For T2S, in terms of take-up, the numbers that we had, that the ECB shared, was that about 65% of transactions were eligible for partial settlement. And in fact, 15% of the transactions actually end up with at least one partial. Like Simon said, there could be many partials in the end, but at least one attempt of partial settlement. In the ICSDs, in fact, the take-up is still smaller, which isn't surprising, as this is relatively recent. I think that we see that maybe half of the instructions are eligible for partial, and we expect that to grow because clients are still onboarding. We still have discussions with some of our big participants who are still making some of the IT developments. But we've already seen in the ICSDs anyway, we see an improvement for settlement efficiency. For debt instruments, this is maybe 0.5%. So it's hard to see if that's accurate, because you have to combine it with everything else that's in the mix and that impacts the efficiency. But we do see a positive trend, and we're still working on gathering all the right data. So we hope that will increase. But like we said, we're stuck. We seem to be stuck at about 65%. Simon, you'd mentioned about the problematic around the use of omnibus accounts. So of course, this is actually there is actually a service that already exists in T2S, a partial release. So that allows a participant to choose to ask for partial rather than the infrastructure actually just auto partialing itself. Now, at the moment, the take up in T2S is still quite small. It's a few thousands of transactions. But I know that there are plenty of custodians who are actually working on implementing that during the course of this year. I mean, I can include Euroclear Bank in that list. So that's something that we all see that needs to be done. So it's going to be interesting to see how that's what impact that will have, because there's an immediate impact for those custodians, but it's how it affects the whole chain. So we hopefully will see some changes on that later this year. Maybe I should also comment on the auto borrowing, because I think there you've got completely the opposite. That's a really mature product, and in terms of take up, it's actually a tool that's already very widely used within the ICSDs. But of course, it needs to also be made more widely available within the CSDs. So both of the ICSDs are extending those services to actually allow fails curing for fails that are seen within the CSDs in the group, where that's already live in Euroclear France. So this should also help to make it more widely available as well.
Thanks, Rebecca. Gareth, what do you think from a trading perspective? What's holding market participants back?
Well, look, I think industry consensus is very difficult, right? The market has a very diverse set of types of participants, and one thing we can totally agree on is that it's hard to agree. You know, we saw some of the debates we've had over the last few months, like so many different perspectives to take into account. You know, just think like, you know, Simon alluded to some in terms of the technical implementation of some of these things. You know, some market participants, they have quite basic systems. They might not be able to do some of the things we're recommending yet technically. Also, the measures we're recommending might not come for free, right? There's no free lunch in this, and that will cause a friction in terms of implementation. And then there are other nuances and considerations to take into account within the recommendations themselves. So just take the simple example of auto borrow programs at the CSDs or ICSDs. These are essentially SBL or like repo transactions, right? They involve credit risk. They're credit risk of the CSDs or the ICSDs to market participants. So it's not, you know, it's not just switch on an auto borrow and off you go. There's actually risk involved in these transactions to consider. But I think the key here though is we need to just start formulating and clarifying these. You know, I think what we've come out with is a set of practical things the market can do to improve efficiency, and then we need to move on to implementing as many as we can as quickly as we can.
No, but with that, thanks, Gareth. Let's come on perhaps to the concrete next steps. You know, what needs to happen now so that we make actual progress. I mean, you know, you mentioned some of the obstacles and some of the good developments that have already happened. But how can we make sure concretely from an ERCC perspective, you know, that these recommendations have an impact and that we will see some real change, hopefully rather sooner than later, given that, you know, CSDR is just around the corner. So there is actually quite a big time sensitivity here. Gareth, let's start with you, perhaps from a ERCC chair.
I think step one, which was the hardest piece. I think the hardest piece was coming together and coming up with and creating some sort of consensus, right, to create the principles themselves. That was the first step, and that was tricky to come out with these things which are, you know, are going to be meaningful and also shown from the data, right? So the data proves that, you know, if we can implement these things, it will make a difference. I think the next step is then to clearly put them into the best practice. You know, so best practice, whether that's part of the guide, and also it starts here, right? So we start to talk about these things. You know, we need to start to change that, almost push the culture that these things become normal, that we partial transactions, we shape transactions, etc. And then look to actually then to go even further into implementation. You know, it's going to take a while. We need to continue the momentum. We need to get together for within the ERCC wider market. We need to get together for workshops on some of the challenges that we talked about in terms of implementation. And we might also need help from the central banks and the regulators to make it reality. We're not sure. I think we're clear on what will now have the impact, and it's up to us as an industry together to do these things.
Good point. Would have been my next question around, support from regulators and central banks. Okay. James, we had some discussions already on the upside on concretely next steps. Can you say a bit more? What's your view on next steps?
Look, thanks, Alex. I think Gareth kind of coined it really well, right? And we talk about the fact that a list of recommendations, and I think perhaps some of our audience thinks, this why are they making this sound so easy? And I think Gareth explained it. It isn't easy. We're on a journey here, and clearly these changes can't happen overnight, because otherwise they would have already happened. What we'd like to do now is to really take each of the recommendations in turn, and then further engage the relevant parts of the industry to document the data points, the challenges, and then plot a path for how we can use each tool kind of going forward. What we'd like to do is really to have workshops on each of these individual recommendations. It's going to take time. We're going to look to kick off these workshops later in the spring. As we said earlier on, we welcome further engagement. So if anyone within the audience would kind of like to get involved in these workshops, please do let Nick, myself, or Alex or Gareth know. We're kind of very much open to kind of new people joining. And what we'd like to do is take each one in turn and then really measure the impact that will have on the overall settlement efficiency rate and improvement potential that we could see in Europe. So much more to come, more workshops, taking each recommendation individually, starting later in the spring, I think is kind of the immediate next step.
Thanks, James. And then Nick, coming on to you, first of all, on the question, but also perhaps to say a few words about, the very good and close collaboration that we're having in this context with the ECB and the different T2S stakeholder groups. And Fiona already mentioned it earlier, but
yeah. So a number of these doors are already open for us in terms of kind of assessing the effectiveness of the industry. I think if we look back over the last sort of 12, 18 months, I think it would have, it would have been quite difficult, 18 months ago to kind of understand the sequencing of the activities. We had some, accessible but difficult to kind of interpret views in terms of inventories into the overnight and settlement efficiency through the day, and some raw sort of data in terms of the empirical level on fails. But I mean, thanks to the ECB intervention and in particular a number of specific settlement efficiency workshops that have been kicked off over the period, I think we're actually now working at a much more collaborative level, in cooperation with the ECB, the CSDs, and key market participants to really kind of expose meaningful and data sets which we can translate into operations outcomes and solutions. And specifically, we've got there's a workshop in June, which we're gearing up to with the enriched views. We'll be able to bring in components and measurements on shaping at an industry level. Further kind of explore the equity versus fixed income and capital markets balancing, and also we haven't mentioned it today, but there are some perspectives there in terms of the actual CSDR components as well, in terms of age of that inventory, and how it behaves through intended settlement date and beyond. So as we I think we will have shortly a much more three-dimensional view in terms of how Europe is operating, and then it's really for us to be able to understand how effective our proposals are in terms of landing into that environment. And that's where the data-centric approach, I think will help us, and and hopefully we'll be able to come back on a more frequent basis and show actually where those investments are really starting to kick in from the middle of this year into Q2, Q1, Q2 next year, where we clearly need to have made a difference.
Okay, thanks, Nick. And that is a nice segue into the kind of the final question, which was really around, timing and what it's very much linked to the next steps. But what is our kind of our perspective here, our timing perspective? You know, when do you think we will see some actual progress on this? Perhaps Rebecca and Simon, first to you, and then for the others to comment on that. Rebecca, do you want to?
I mean, we say what we'll be talking about in 5 years or whatever. Well, I very much hope that the work we're going to do now is really going to change things before, you know, in the next 5 years, that we won't still be talking about the same thing, maybe something completely different, I hope. Maybe we'll be talking about changing settlement life cycles or timings or something else, but we need to move on this now.
Yeah.
Okay. I think, you know, as we look, you know, 5 years down the path, maybe, you know, there's an opportunity to apply machine learning techniques to help improve settlement efficiency. You know, by way of example, BNY Mellon is uniquely positioned in the US marketplace for Fed eligible securities. We process around $8.6 trillion of Fed eligible securities on a daily basis. And we've been leveraging machine learning techniques to help predict a material amount of fails and cancels with a high degree of certainty in the US. The key, of course, when doing something like this is having line of sight into a lot of data. For example, our service takes into consideration elements like velocity of trading in a given security across different time horizons, the volume of bonds circulating, the bond scarcity and the number of trades selling every hour, and any operational issues like higher than normal cancellation rates. So I say that to highlight it might be challenging for individual institutions to do this with a high degree of accuracy due to lack of data available. However, as an industry across Europe, maybe it's something to consider at the CSD or T2S level, but I do think that's an interesting angle to further investigate. And the other thing I briefly mentioned is distributed ledger technology. You know, clearly an interesting topic of conversation across the industry right now. And I do think that technology has the potential to enhance inventory management and settlement efficiency as well over that type of time horizon.
Thanks, Simon. Perhaps for the others, I mean, we have still a couple of minutes perhaps, but any other views on the timing question perhaps?
I think it was mentioned previously that, I mean, it does take time. There is some time to market to deploy. You know, so you know, looking at the operational implementation in terms of auto parshaling at a system level, you know, it isn't an overnight kind of process. You know, and more than anecdotally, you know, we hear that there's a lot of work, you know, working through the sub-custodial kind of frameworks and a number of the outsourcing, you know, models as well to help facilitate, you know, these deliveries. So I think we're hearing that there are encouraging signs, but I suppose the jury's out until we actually start to see the, you know, the actual, you know, the returns on that in the numbers.
I was just going to add, Alex, the other thing, you know, you say when do we do this? Like, start now, start today. When you go back to your desks today, if you trade a 500 million trade with someone, go shape that trade. If you can do it, shape that trade and start to get the message out and make this thing real. Yeah.
And the only thing I'd add to all of that, agree with all of it, is it's a team effort. You know, from trading to operations to inventory managers to custodians. This is a team effort. No one segment of the market can achieve this on their own.
Hashtag better together. Okay.
I think that's a very appropriate conclusion for the panel. No, perfect. Thank you very much. It was a really good discussion and certainly not the last one we've had on this topic. So we'll come back on it. As we're approaching the end of today's agenda, there's one last highlight still to come. So I'm very pleased to hand over to Corentine Poilvec-Ledière, the head of Repo Clear, Collateral and Liquidity at LCH SA, and the host of today's AGM. So Corentine, many thanks for supporting today's event. So over to you for the concluding remarks.
Yes, thank you very much, Alex. So as you said, we as LCH were quite delighted to virtually welcome you today for this AGM. We would have been even more delighted to physically welcome you, but that might be something for the next year. So more than just being happy to welcome you, I was quite personally thrilled to see the diverse set of panelists and distinguished guests that intervened as we basically took stock of ICMA's priorities, but also the core trends that are structuring and shaping our markets, as we heard directly from Fiona from the European Central Banks on continuing to defragment such markets and create scale. And also as we continue to learn to sit at the same table and list all the tools we have at our disposal and those that we should create to just become more efficient in the settlement space. Obviously, we are all still speaking from a place of challenge. With more than a year into this pandemic, this unsettling time has proven many things, but amongst those, it's proven even more than ever the necessity to stay very, very connected as an industry and as a market. Connected with partners, connected with clients, connected with the authorities, connected with the central banks, connecting with the key systemic infrastructure. And why stay connected? Not for the sake of it, but to make sure that our market remains very palpable, it's dynamic, very understandable, and that basically we work towards efficiency. So as we wrap up today, I suggest we take a very, very quick step back on what we've heard in terms of core trends. Because of course, I'm just like you, as market practitioners, we kind of easily get caught on our next technical challenge. You know, how are we gonna comply with CSDR buy-in? How is it going with the matching rates of SFTR, CR2? How should we think about predictive fails and green bonds and so on? And we've done that today, and that's always a thrill to exchange on those topics. And yet, let's reflect on what the survey has told us, because we all base everything on this. The survey is confirming the fact that we do operate on a fast-growing market. I mean, when you think about what Richard has presented today, just between June and December last year, we're speaking about a 5% growth. So that is still a segment of market that's probably 7 to 8% annual growth. So really, really significant there. And we know why. We know why, because obviously it is the underlying asset that keeps growing for good or bad reason, but this is what it is. So government bonds are being issued as central banks and governments stepped in, especially last year, to support real economy, households, workers. And as they do that, what they effectively do, and many of you are here today, collectively, they come to us as a market, they come to face the market to talk about long-term prosperity and test the trust and the appetite and the capacities of such market to support these moves. And then the third element of this triangle, we seem to love triangles today. I know Fiona used also a triangle analogy. It works really well in our market. The third element to this is that market I'm talking about, specifically the sell side first. They receive these, they see these basically ambitions from the states, and they need to then check in on their own capacity as they find themselves under more and more pressure to comply with a variety of rules, a variety of regulations that constrains their balance sheets to serve their clients who themselves by side have to serve their own clients. So because of these core trends, the objective that we should give ourselves are really efficiency, efficiency, and efficiency. Efficiency in selecting the right partners. We're talking about, the assessment location, the choice, the clearinghouse, the liquidity pool, the broker. Select your partners, work with them, deepen the relationship, and basically encourage all of us infrastructure to be better at the offering that we give you. But also efficiency in the set of choices. We believe in a market that chooses where it wants to do things for the right reasons. That's what's sustainable. And that includes giving more options, including to buy side, to access clearing should they wish to do so. And I'll get to that. Efficiency in the reactivity that we collectively have. When there is the right new issuance coming in, I'm thinking about the recent Italian bonds, green issuance, the German issuance, the raise of green OATs, but also, of course, as we are talking about the European market, the SURE program for unemployment and the next generation EU that is expected to continue to be issued over the next years. All of us, with our expertise and our role, we have to be in the front foot and be there from day one to support the efficiency of those issuances. But efficiency is also about keeping an open-mindedness on how we think about the tools that we know so well. So if I speak for myself, it's about, when I'm thinking repo clearing, can I shape my operational sequencing better so that pension funds can use me in a more easily manner to basically generate cash to maybe clear another asset class, such as interest rate swaps? So always keep it creative. And efficiency, as we've seen in the last panel, is also just knowing when to regroup and basically do the inventory of what we have available for settlement efficiency and what we should do next, and encourage each other, as Garrett has done, to just crack on with it and bring that efficiency into real life. At LCH, I want to use this occasion to thank all of you as an industry for the 191 trillion euros in cash value that you trusted us to clear last year, or if you prefer counting this way, more than 7 million trades. It is always an honor that you trust our expertise to take care of those flows and keep them safe, cleared, and efficient for you. We have now daily performance that are around higher than 900 billion euros, and that's because of your trust and because of the way we think that we have to respond to your need. And this is something that we are committed to continue to do every day. We want to thank you for this. We are very proud to have your trust there. We're also very proud to not just serve you every day, but to have served you also at the peak of the COVID crisis. Clearing has to be relevant for BAU financing requirements, but it also, of course, has to be even more relevant when the tensions are at their climax on the markets, like we've seen last year. And when that happens, the key is that you find with us not only the liquidity, but the predictability and the stability that you are craving, the safe harbor that you might be seeking at the time. And we're quite pleased to report that we've been able to go through all of the year without changing a single comma to our parameters, making us highly predictable. But we're not just proud, we're excited. We're excited about the future. We're excited about making sure that we continue to build that trust, especially with the buy-side population, which continues to be, for a large segment, operating away from clearing. We've heard from the ICMA survey that it's about 49% of our market that remains bilateral. Many of it has good reasons. Not everything is fit for clearing, but there's probably pockets of efficiencies that can be unlocked in this space. And we have a key role to play with our sponsor clearing model to create those bridges. And there is already a steep growth in the sterling market there. We're quite delighted to confirm that the euro offering is going to be business live this summer, and that we're working with key buy-side participants to bring this efficiency and these bridges into the picture. You've done correctly. Sponsor clearing is a virtuous circle. It will bring more liquidity and diversity into the clearinghouse. It will bring additional access to liquidity to the buy side, and it can bring a much desired relief to some of the tension that the sell side have to face in their balance sheets. So as Nick said, better together, that's yet another example of how our market and its structural initiative work as an ecosystem. And finally, we're also excited because there are so many more things happening, and we know that you are all focused on, amongst many other things, financial optimization, because you have to, and that's sell side and that's buy side. And we feel as infrastructure that we must provide for you very concrete options to help there. And that is being done through a variety of initiatives. I'll only mention two for today. It's the large widening of the collateral that is going to be made eligible for LCH in Paris. We are going to launch around the month of June a much wider range of non-euro, non-cash collateral eligible. It's going to be Japanese government bonds, Canadian dollars, Australian dollars, but also the European kronas. So you can pick and choose better, and you can optimize the tri-party service to do a substitution on top of that. And the second initiative that we are working on quite a lot today to respond to many of your wishes and comments and discussions we've had is the merger of our general collateral service with RepoClear, the special service, bringing it all together in a single pool of liquidity that offers you netting across. So this is something we are hard at work on. But enough about LCH. Today was about all of us and how we unpick and how we overcome the challenges of today and tomorrow. So it's been a fascinating journey to hear about all of you. And the final word I would say, which I will take away from this event, is when we collectively grow the liquidity, we keep an open choice access, open choice mindset. We welcome new participants, and as such, we promote euro as an international currency. We all win. So that was quite reassuring to hear about all of you today and get these these key messages confirmed. So thank you very much for this. And I think I hand over to Gottfried.
Thank you, Corentin, and thank you very much for LCH for sponsoring today's event. It's without people like you, organizations like you, we will never be able to bring to our large audience well over 100 people today that listen to our recommendations and our work on behalf of the whole industry. The next event will be in October, will be virtual again. And it rests me one thing to thank everybody who has contributed to today, and have a happy Easter holiday. Thank you very much.